Good day. For this case study, we will analyze JFC or Jollibee Foods Corporation and Shakey's Pizza Asia Ventures Incorporation or SPAVI. I'm Carmela and I am joined with Ken, Paolo, and Adrian. Let's move forward to the introduction of the companies and accounts. For Jollibee Food Corporation, or JFC, they rely on its commissary system to standardize operation and reduce costs. Its diverse portfolio includes brands such as Chowking, Mang Inasal, and the Coffee Bean and Tea Leaf. This global strategy is reflected in its balance sheet, where inventories and cost of sales account for significant portions of its financial activity. For the key strengths, strong brand recognition, diversified portfolio, effective localization strategy. And for SPAVI, they prioritize cost efficiency and simplicity, focusing on pizza-centric menus. The franchise model enables SPAVI to minimize corporate-level inventory responsibilities while leveraging its Supercard loyalty program to encourage repeat visits. The analysis emphasizes inventories and cost of sales as key metrics for understanding their operational strategies. Which sub-item contributed the most? For balance sheet and JFC, we have inventories and the event increase in sales, while for SPAVI, we have inventories and the event increase in NRV. JFC's consolidated statement of financial position shows an inventories account of 12 and 340.21 million pesos, likely driven by increased sales requiring more raw materials to meet customer demand. For SPAVI, the inventories at 1 and 712.22 million for 2023, primarily influenced by the NRV of merchandising. This inventory cost significantly impacts the company's cost of sale. For the cost of sales breakdown reveals the cost of inventories contributed of 113 and 997 million or 46.7% of total sub-items. This sub-item increased by 14 and 723.8 million from its 2022 amount of 99 and 273.2 million pesos, marking the greatest growth. For SPAVI, we have inventory costs accounted for 58.4% of 2023 total costs, showing a notable 26.4% increase from the previous year.
Now we ask why these are important to the company. Inventories and cost of sales are crucial for both companies. GFC's 12.34 billion peso inventory includes raw materials, semi-finished items, and finished goods distributed through its commissaries. This centralized system ensures product consistency but increases risks such as spoilage and obsolescence. The company reported a 49 million peso provision for obsolescence in 2023 to account for potential waste. SPAVI's 1.71 billion peso inventory is much more simpler, comprising primarily raw materials for its pizza-focused menu. The company relies on third-party suppliers, which reduces internal complexity but exposes it to supply chain disruptions. SPAVI reversed 4.8 million peso in obsolescence provisions due to efficient turnover. Cost of sales is another critical account. JFC's 198.6 billion peso cost of sales reflects its commissary expenses and global logistics of 8.63 billion pesos, which compress its gross profit margin to 20.2%. SPAVI's 9.67 billion peso cost of sales, representing 75.4% of revenue, supports a higher gross profit margin of 24.6% due to its localized supply chain.
So why then is this important to other industries? The inventories is critical as it highlights inefficiencies, supply chain disruptions, or rising raw material costs, all of which influence pricing adjustments and supply chain strategies. Proper inventory management impacts cost of sales, profitability, and operational efficiency, enabling companies to optimize operations and make strategic decisions that affect their bottom line. First, for the pharmaceutical industry, inventory costs are strategic assets, representing a significant portion of the cost of sales. Effective management of raw materials, such as active pharmaceutical ingredients, ensures compliance with strict regulations in expiry dates and storage. Rising inventory costs may signal inefficiencies in production or supply chain issues, impacting pricing strategies and market share. Next, for the manufacturing sector, managing inventory prevents overstocking or stockouts, stabilizing production costs. Fluctuations in inventory levels often require manufacturers to reevaluate supply chain processes, avoiding spikes in the cost of sales. For the hospitality industry, for the cost of sales, the hospitality industry, this includes food, beverages, and operational supplies. Mismanagement or rising in-region costs may reduce profit margins or force price increases, which can risk customer loyalty. Supply chain issues might prompt bulk purchasing or new supplier evaluations. For the technology sector, this covers materials like semiconductors, labor, and transport. Fluctuations in raw material costs, such as rare earth elements, drive companies to explore alternatives or recycling programs. Supply chain disruptions, like chip shortages, may require renegotiated supply contracts or revised production schedules. And last, the fashion industry. This encompasses fabric production and labor costs. Rising materials costs due to tariffs or weather impacts procurement. Companies may adjust pricing, reduce production, or adopt sustainable materials to address inefficiencies. Overproduction or underproduction affects inventory levels, influencing profitability.
So for inventory comparison, the difference in inventory and cost of sales between JFC and Spavia are reflective of their vastly different operational models, business strategies, and scale. So first, let's do the inventory comparison of JFC. Has a value of 12.34 billion pesos, which far exceeds Spavia's 1.71 billion pesos, which is expected given JFC's global reach and multi-brand portfolio. JFC's inventory includes raw materials, semi-finished products, and finished goods distributed across multiple countries. The company's centralized commissary system is a crucial part of this inventory management, which processes raw materials into semi-finished goods to ensure consistency and cost efficiency. However, such complexity brings inherent risks such as spoilage and obsolescence, especially with perishable items. The 49 million peso provision for obsolescence highlights GFC's effort to account for these risks, ensuring that these outdated or spoiled inventory does not skew the company's financial health. And for Spavi's inventory, by contrast, is smaller and more streamlined, reflecting its localized operations and narrow product focus. Its inventory consists primarily of raw materials for pizza and related products such as dough, cheese, and sauces. It relies on third-party suppliers for these ingredients, which reduces the complexity of its internal operations, but increases dependency on external factors. Despite these limitations, it reversed 4.8 million pesos in provisions for obsolescence in 2023, showcasing its ability to manage inventory effectively with minimal waste. Its efficiency reflects the simplicity of the supply chain and the effectiveness of its inventory turnover practices. Now for the cost of sales comparison. JFC's 198.6 billion cost of sales accounts for 79.8% of its revenue. It reflects its operational scale and expenses tied to its commissary's operations and logistics. A significant portion of this cost stems from 8.63 billion pesos in logistics expense, which are necessary for sourcing raw materials globally and distributing products across the regions. This high cost of sales compresses JFC's gross profit margins to 20.2%, emphasizing the need for cost optimization. On the other hand, Spavi's 9.67 billion cost of sales represent 24.6% of its revenue. It supports a much higher gross profit margin of 75.4%, and this highlights Spavi's linear operations and localized sourcing strategies, which allow it to maintain profitability despite its smaller scale.
The methods of reporting for JFC and SPAVI differ significantly, reflecting their operational structures and priorities. JFC's reporting is comprehensive with a detailed breakdown of its inventories and cost of sales. The company categorizes inventories in raw materials, packaged items, and packaged goods, and expenses into logistics, commissary utilities, repairs, and depreciation. This approach reflects the complexity of managing a global supply chain, where each cost component must be monitored to identify areas for efficiency improvements. JFC's provision for obsolescence, amounting to 49 million pesos, is a crucial part of its reporting, ensuring that the financial impact of unsellable inventory is transparently accounted for. This level of detail demonstrates JFC's commitment to maintaining investor confidence and addressing the risks associated with its inventory operations. Spavi's reporting, in contrast, emphasizes simplicity and efficiency, aligning with its localized and franchise-driven model. The company focuses on metrics like inventory turnover and supplier management to highlight its operational efficiency. For example, Spavi's reserve of 4.8 million pesos in provisions for obsolescence demonstrates its ability to manage inventory with minimal waste. Unlike JFC, Spavi does not need to account for complex logistics or diverse product lines, allowing for more straightforward financial reporting. However, the simplicity also limits the scope of its insights, particularly in identifying opportunities for scaling its operation.
Now, the line items of inventories and cost of sales reveal critical insights into how companies like JFC and Spavi achieve their respective business objectives. In terms of the inventory's impact on success, next slide please. JFC's inventories are expansive and diversified, supporting its multi-brand portfolio and global operations. The centralized commissary system ensures that products are consistent in quality across regions, a key factor in maintaining its reputation and customer satisfaction. However, the scale of these operations introduces challenges such as managing spoilage and ensuring efficient logistics. The 49 million peso provision for obsolescence underscores the risks tied to JFC's reliance on perishable goods and the need for better demand forecasting. Spavi's inventories, by comparison, are limited in scope, reflecting its focus on pizza and related products. The company's reliance on third-party suppliers simplifies its inventory management, but creates vulnerabilities in the event of supply chain disruptions. Despite this, Spavi's ability to reverse provisions for obsolescence highlights its success in maintaining efficient turnover and minimizing waste. This efficiency contributes directly to its high gross profit margin, supporting its profitability and reinforcing its brand value. Uh, for, for the impact of cost of sales, it is equally telling because GFC's high cost of sales compresses its gross profit margin, limiting its ability to reinvest its growth initiatives. Conversely, Spavi's lower cost of sales allows for greater flexibility in allocating its resources, such as marketing and in innovation. These differences illustrate how operational scale and complexity influence financial performance and long-term sustainability.
Both JFC and Spavi exercise significant control over their inventory and cost of sales, though their approaches differ. JFC relies heavily on its commissary system to centralize production and distribution. This system provides economies of scale and ensures consistent quality across its brands. However, the scale of these operations makes JFC more susceptible to inefficiencies, such as overproduction or delays in logistics. The 49 million peso provision for obsolescence reflects JFC's challenges in managing spoilage and excess inventory. To improve control, GFC should invest in advanced demand forecasting tools and strengthen its logistics network. Spavi, on the other hand, delegates much of its inventory management to franchisees, reducing corporate level responsibilities. This decentralized approach allows Spavi to focus on supplier relationships and quality assurance. Its efficient inventory turnover, evidenced by the reversal of 4.8 million in provisions for obsolescence, highlights the effectiveness of its operations. However, Spavi's reliance on suppliers limits its control over raw material costs and availability, making it vulnerable to external disruptions. Strengthening these relationships and diversifying its supplier base could enhance Spavi's control over its line items.
Effects on other financial line items. So JFC has a compressed gross profit margin of 20.2%, largely due to a high cost of sales, which accounts for 79.8% of its revenue. This reflects the challenges of managing global operations and high logistic costs. On the other hand, Spavi boasts a higher gross profit margin of 75.4%, thanks to linear cost of sales at 24.6% of revenue, driven by localized sourcing and simpler operations. At operating income, for GFC, the lower gross profit margin impacts its operating income, as the remaining revenue must cover substantial global operating expenses. For Spavi, they benefit from its linear cost structure, resulting in higher operating income relative to revenue. With net income, they further highlight the effects of these cost structures. JFC's high cost of sales erodes its net income unless offset by revenue growth or improvements in operational efficiency. Conversely, Spavi enjoys a higher relative net income due to its lower cost of sales despite its more limited scalability compared to JFC. For inventory and accounts payable, JFC requires larger and more diverse inventories to support its global brands and commissary operation. And Spavi, with its localized sourcing and smaller scale, maintains smaller, more focused inventories. Additionally, JFC's extensive global supply network leads to higher accounts payable, whereas Spavi's smaller scale results in lower accounts payable, reflecting its localized procurement strategy. For the cash flow, GFC experiences higher cash outflows due to significant procurement costs. However, these are partially offset by delayed payments through accounts payable. In contrast, Pavi's leaner cost of sales and localized operations support efficient cash flow management, allowing the company to maintain a healthier cash position. For logistic costs, GFC incurs substantial logistic expenses amounting to 8.63 2 billion pesos primarily due to international freight and distribution costs. And Spavi, benefiting from its domestic focus, keeps freight costs negligible, which helps it maintain lower overall logistic expenses. For revenue growth and scalability, GFC's high cost of sales enables its expansive store network and diverse product offerings, driving higher absolute revenue. However, this comes at the expense of profit margins growth. Spavi's lower cost of sales enhances its profitability, but it limits scalability. And finally, let's understand why JFC has higher inventories and cost of sales. JFC has global presence in a diverse brand portfolio, and its absolute cost of sales is also higher due to the scale of its operations and the complexities of international logistics.
So for the impact on the strategy of the companies, for GFC's inventory strategy, one of its key strengths is its high inventory levels, which supports diverse brands and extensive global operations. The company's centralized commissary streamlines the processes and the distribution of raw materials, ensuring consistency across regions and economies of scale. However, there are notable risks over JFC's over-reliance on imported materials, as it makes it vulnerable to currency fluctuations and geopolitical risks. Additionally, the complexity of managing global inventory increases the potential for waste and inefficiencies, especially for perishable goods. To address these risks, it should enhance inventory forecasting to better predict demand and reduce waste. And another actionable focus is to diversify sourcing strategies by incorporating more local suppliers to reduce exposure to international uncertainties. For their cost of sales strategy, its strength lies in its economies of scale achieved through its commissary system, which reduces relative cost of sale across its global operations. Furthermore, its diverse product portfolio helps balance cost inflations, as one brand's rising costs can be offset by another. However, rising global logistics costs and potential supply chain disruptions pose significant risks that could inflate cost of sale over time. To mitigate these challenges, it should invest in automation and local production facilities to improve efficiency and reduce reliance on costly logistics. Additionally, regularly evaluating supply chain resilience and renegotiating supply contracts can help ensure stability. For the analysis on Spavi, for the inventory strategy, the cost benefits from its smaller localized inventory, which minimizes risk and spoilage. This approach aligns well with its lean operation and narrow product focus. However, its limited scalability and dependency on local suppliers make it vulnerable to disruptions in the supply chain. You can address these risks by exploring regional expansion to increase inventory scale, which reduces per unit cost and enhance operational stability. Strengthening supplier relationship is also critical to ensuring reliability and flexibility in supply chain. For their cost of sales strategy, one key strength is its lean operations, which results in relatively efficient cash flow and supports profitability. However, the it faced risks such as higher relative cost of sale due to its dependency on external suppliers and lack of economies of scale. Additionally, the company is susceptible to price fluctuations in core ingredients like cheese and flour, which are essential to its menu. To counter these risks, Spabri should focus on negotiating better terms with suppliers or adopting bulk purchasing agreements to reduce costs.
In conclusion, GFC and SPAVI represent two distinct approaches to managing inventories and cost of sales. GFC's global model prioritizes scale and consistency, but comes with higher complexity and risks. SPAVI's localized approach emphasizes simplicity and profitability, though scalability remains a challenge. Both companies illustrate the importance of aligning financial strategies with operational goals. Effective management of these line items ensures sustainable growth and competitive advantage in the food service industry. Thank you for listening.